Imagine buying a brand new $40,000 Nvidia GPU. You slot it into your server rack, fire up a massive language model, and then you just watch it throttle to half speed.
Right, which is a total nightmare.
Exactly. And why?
Yeah.
Because the microscopic copper wires sitting next to it literally melted from data friction.
Yeah, that is the brutal reality that hyperscalers are facing right now.
It really is. You look at traditional data center architecture and, well, it's built on this massive assumption, right, that we can just keep pushing electrical signals through copper indefinitely.
Which is physically impossible at this point.
Exactly. When you step into the architecture of a modern AI training cluster, the physical laws of heat and electrical resistance are, they're actively colliding with compute.
It's a hard wall.
So we are tearing through a massive stack of technical research papers, fresh earnings reports, and deep financial analysis today. Our mission is singular. We are uncovering the ultimate truth about the AI infrastructure bottleneck.
And we're not sugarcoating the numbers.
No, we're not. The thesis for this deep dive is aggressive, but it's entirely backed by the data. We are talking about top AI Photonic stocks to buy now before it is too late.
Because AI data centers have fundamentally outgrown legacy electrical I/O.
Period. We are staring down a hard, unavoidable architectural shift toward photonics.
And look, the market is incredibly mispriced right now. Retail investors are buying up compute layer stocks like they are water in the desert. They are obsessively focused on the GPUs.
Right. Everybody loves the GPUs.
But a GPU is just processing muscle. The real alpha, the actual limiting factor for hyperscale deployment, is the communication fabric connecting those processing units.
It's the nervous system.
Exactly. So we are bypassing the casual commentary today. We are going straight into the raw data, the exact valuations, and the system-level physics driving the optical interconnect stocks that are positioned to absolutely dominate this transition.
Okay, let's unpack this, because the general market assumes that we just, keep plugging faster fiber optic cables into the edge of the server rack, like upgrading a home router.
Yeah, which is just a hilarious underestimation of the problem.
Totally. This new ArcSiv research paper on 3D optoelectronics absolutely shreds that assumption. Legacy optical I/O is dead. Modern AI workloads require dense, low-latency, all-to-all communication across tens of thousands of accelerators simultaneously.
And they cannot tolerate latency variability, not even a little bit.
Right.
That is forcing a severe architectural pivot.
Because electrical I/O has become a literal physical bottleneck.
The issue is signal integrity. Copper traces, they simply cannot carry 200 gigabits per second over long distances without extreme signal degradation.
And to fix that,
Well, to compensate for that degradation, you have to pump massive amounts of power into the system to drive the signal, which of course generates an untenable amount of heat.
right.
So the optics are being forced to migrate inward, closer to the compute die itself.
Which brings us to the co-packaged optics transition.
Yeah, CPO and 3D photonic integration. You're literally embedding the optical engine into the same physical package as the GPU or the switch ASIC.
And the research highlights a critical shift in how we actually have to value these hardware companies. I mean, classical scaling metrics like simply measuring bandwidth per lane or energy per bit in a vacuum, they're just no longer the primary predictors of whether a system is viable.
Not at all. Packaging has essentially become the new process node.
Wow, yeah. It genuinely doesn't matter how fast your laser is if you can't integrate it into the silicon properly.
And that is the exact point the broader market is missing right now. The street views co-packaged optics as just another component-level upgrade, right? Like a simple swap.
Just pop a new one in.
Exactly. But that is entirely wrong. It is a massive architectural commitment. When you embed optical I/O within the compute package, you destroy the old modularity of data centers.
Because of the yield compounding.
Yes. Think about it. If you have a highly complex package with multiple heterogeneous dies and a single optical interface fails, you don't just pull out a pluggable transceiver and swap it for a new one.
Right, you compromise the entire AI node.
Exactly. Furthermore, you have severe thermal coupling. You are placing highly sensitive photonic elements right next to logic dies that operate at hundreds, sometimes over 1,000 watts.
Which is insane.
It is. Heat directly perturbs laser efficiency and resonator stability.
Wait, I have to jump in here and take a highly skeptical stance on this. If we push the optics directly into the silicon package, and the heat from a massive AI accelerator could literally destabilize the laser,
Yes.
doesn't that make fully embedded CPO incredibly risky from a commercial standpoint? Like, Hyperscalers hate vendor lock-in. If you fuse a $100 laser to a $40,000 piece of compute silicon and the laser burns out, you just brick the GPU.
That's the nightmare scenario.
Right, so why isn't intermediate architecture a much safer transition?
What's fascinating here is that the data supports exactly that intermediate approach, precisely because of the commercial friction you just identified.
Okay.
Full monolithic integration is a trap right now. The market's real solution is chiplet-based optics.
Chiplets.
Yeah, chiplets offer logical modularity. By placing the optical engines near the compute die, but utilizing standardized die-to-die interfaces rather than fusing everything into a single monolithic block, you preserve the short electrical reach required for high speed.
While still allowing localized replacement.
Exactly. You mitigate that thermal coupling. The companies that win this space will not necessarily be the ones with the lowest reported power consumption on paper.
Right.
They will be the ones that actually solve the manufacturing yield and thermal constraints at scale.
Which perfectly brings us to the financial reality. Let's shift our discipline purely to earnings, valuations, and direct stock comparison. Nvidia clearly knows this system-level bottleneck exists.
So they are acutely aware.
Right. They just poured a massive $2 billion strategic investment into each of our top two photonics players. Lumentum, ticker LITE, and Coherent, ticker COHR.
Two identical capital injections.
But fundamentally different risk profiles for your portfolio.
Exactly. You have to look at their asset profiles. They are operating on entirely different business models, manufacturing footprints, and time horizons.
Let's start with Lumentum. This is what we're calling the sharper blade. We are looking at a $61 billion market cap with essentially zero debt.
Clean balance sheet.
Extremely clean. As of late April 2026, the stock is up 132% year to date, and the forward estimates are just staggering. Wall Street sees EPS estimates for fiscal year 2028 soaring to $25.42.
It is a highly focused, clean sheet bet purely on CPO laser demand.
Right, because they don't have legacy manufacturing bloat. When CPO ramps from 0 to 1, Lumentum has massive operating leverage. The revenue falls straight to the bottom line.
It is a pure play, but look, you pay a premium for that purity.
Yeah.
The forward price to earnings ratio is hovering around 62.
Yeah, it's not cheap.
Not at all. Now contrast that with Coherent. This is the heavier machine. It is a massive, vertically integrated platform covering materials, devices, and systems end-to-end.
The whole stack.
The whole stack. Their Q1 fiscal 2026 revenue just hit $1.58 billion, representing a 19% pro forma year-over-year growth. Non-GAAP gross margins hit 38.7%.
Wow.
And crucially, on the manufacturing side, they are the first to mass-produce 6-inch indium phosphide wafers.
Okay, stop right there and explain why the wafer size actually matters to an investor. Why should a portfolio manager care about 6-inch versus 4-inch wafers?
Because it completely rewrites unit economics. A 6-inch wafer doesn't just offer slightly more surface area than a legacy 4-inch wafer.
Right.
The geometry actually means you lose far less usable silicon to the curved edges of the disk.
That makes sense.
The actual output of viable lasers is 3 to 4 times greater per manufacturing cycle. It drastically lowers the per laser cost, which allows Coherent to defend its margins even if hyperscalers start demanding bulk pricing discounts.
But let's look at the balance sheet. The street is looking at Coherent's $5 billion debt from their legacy acquisitions like it's a radioactive asset.
They hate it.
They really do. The consensus loves Lumentum's clean financials and heavily penalizes Coherent for being over-leveraged. So what does this all mean? Debt is still a shackle.
Usually, yes.
If these AI data center build-outs pause for even a single quarter, doesn't Coherent's massive leverage just magnify the cash flow contraction? I mean, the interest payments don't stop just because orders slow down.
And that is exactly where the mispricing lives. That's where the alpha is hiding. The market is looking at Coherent's debt purely as a liability. They are completely missing the fact that it provides a second, entirely independent EPS growth engine.
Wait, really? How?
Systematic debt reduction. Let's look at the mechanics. In fiscal 2025, their annual interest expense was around $240 million. They just paid down $400 million of principal.
Okay.
As they accelerate debt repayment and refinance at better rates, they save $50 to $60 million after tax annually.
Wow.
That translates directly to an extra 30 to 40 cents in earnings per share without having to sell a single extra optical module. It is literally a synthetic earnings engine.
So what does this all mean for risk preference? You're saying Lumentum is the lower friction play in a perfect bull market, but Coherent has these hidden levers.
Precisely. Lumentum is a bet on scarcity at the optical chip layer. Coherent is a debt on the manufacturing foundation of the entire optical communications infrastructure.
It's a much broader play.
Exactly.
Yeah.
Furthermore, the market is completely ignoring Coherent's diversification. They completely dominate in ZR and ZR plus data center interconnects.
And to briefly translate that jargon for everyone, those are the high-capacity, long-haul, coherent optical links that connect different data centers across entirely different cities.
Yes, Lumentum has almost no footprint there. On top of that, Coherent has an industrial laser segment that is signaling a cyclical recovery.
Which acts as a leading indicator, right?
Yes, for broader advanced node semiconductor capacity expansion. With a forward PE around 40, the upside leverage is massive if you have the patience to let the debt reduction mechanics play out.
All right, so we've dissected the valuations of the companies building the lasers, but here's where it gets really interesting.
Let's hear it.
There is a massive blind spot in the market right now. You can have the fastest, most cost-efficient optical interconnects on the planet, but they are entirely useless if the motherboard itself is choking the data before it even reaches the laser.
It's the traffic problem.
Exactly. This photonics boom is dragging the entire high-speed connectivity ecosystem up with it. You can't just buy the lasers, you have to buy the digital traffic cops that route this insane volume of data.
Right.
If we look at the forward triggers, Astrolabs, ticker ALE, is a screaming catalyst.
Astrolabs is solving the immediate, unglamorous, system-level bottleneck. They are rapidly ramping production of their PCIe 6 connectivity portfolio.
And their new Aries 6 smart gearbox is the critical mechanism here. When hyperscalers deploy new AI platforms, they rarely have the capital to upgrade every single component in a massive server farm all at once.
It's too expensive.
Way too expensive. So you end up with mixed generation systems, brand new PCIe 7 accelerators trying to talk to older PCIe 5 storage or networking gear.
Which causes massive throttling.
Exactly. The Aries 6 essentially multiplexes and bridges that performance gap. It acts as an intelligent translator between the generations, preventing the slower components from degrading the performance of the entire rack.
Because again, a blazing fast optical laser does absolutely nothing if a mixed generation bottleneck throttles the GPU data ingest.
Right.
Astrolabs is optimizing rack scale total cost of ownership. Their Scorpio P-series smart fabric switches ensure high bandwidth, low latency, peer-to-peer data flow between the GPUs themselves.
Which is critical for training.
Exactly. And what creates a massive economic moat here is their interoperability testing. The fact that their solutions are rigorously tested and validated with AMD processors, Micron high-performance SSDs, and Samsung storage.
That ensures that these massive AI platforms can scale out without crashing.
Yes. Hyperscalers will gladly pay a premium for that guaranteed stability. Competitors can't easily cross that moat because it takes years of joint engineering to guarantee that level of interoperability across different vendors.
And they aren't the only ones executing on the digital side of this ecosystem. You have Marvell, ticker MRVL, aggressively showcasing their 1.6T era T DSPs at the latest optical networking conferences.
We should probably clarify what a DSP actually does in this context.
Yeah, please do.
So a digital signal processor, or DSP, is essentially the digital brain that cleans up and amplifies the messy analog optical signals coming out of the fiber.
Because physics is messy.
Exactly. As data moves faster, the signal degrades into noise. The DSP reconstructs that noise back into clean ones and zeros.
Right. And Marvell's Era T is a transmit retimed optics DSP, meaning it handles the signal conditioning with massive power savings over fully retimed optics.
Which is a game changer for the power budget.
Huge. They are also rolling out PCIe 8.0 SerDes, which are the components that convert parallel data to serial data and back again, and they're developing 3-nanometer die-to-die IP. They essentially own the blueprints for the end-to-end data center connectivity fabric.
They really do.
But we also can't forget the physical layer itself. Corning, ticker GLW, is up 73% year-to-date as the premier fiber cable player. Amphenol, ticker APH, a $182 billion behemoth, is up 9.8% year-to-date.
Even the tiny stuff matters.
Right. Even fractional improvements at the copper and physical connection points remain absolutely critical to rack stability.
The takeaway for the ecosystem segment is that bandwidth demand is holistic. Upgrading the laser explicitly forces an upgrade of the DSP to clean the faster signal.
Which forces an upgrade of the switch to route it.
Exactly, which then forces an upgrade of the physical interconnect to carry it. It is a cascading capital expenditure cycle. Companies like Astra and Marvell are positioned at the exact choke points of that cycle. They're essentially taxing every terabyte of data that moves through the rack.
Which perfectly sets up our final segment, the wild card. We've talked about the architecture, we've priced the immediate photonics players, and we've mapped the ecosystem traffic cops. But as a hedge fund analyst, you have to look at the future technology shifts.
You have to look at the expanding total addressable market.
Exactly. The brutal truth is that legacy materials like silicon photonics and traditional indium phosphide, they are eventually going to hit a hard physical bandwidth and power wall.
They absolutely will. As we push toward 1.6 terabit and eventually 3.2 terabit speeds, the modulation efficiency of traditional silicon fundamentally degrades.
Just can't keep up.
No. The power consumption required to drive the signal through the silicon at those speeds becomes untenable within the thermal constraints we discussed earlier.
Yeah.
You simply cannot cool the chips fast enough.
So what's the solution?
This is where electro-optic, or EO, polymers become the disruptive catalyst.
And the pure play public vehicle for this is Lightwave Logic, ticker LWLG. The numbers they are projecting are wild, but they map perfectly to the physics.
What's the TAM looking like?
The total addressable market for their technology is projected at $24 billion by 2028, and they are targeting a staggering 60% plus gross margin at scale.
That margin profile is entirely a function of their business structure. They are solving the physical limit problem, but they are doing it with an incredibly capital-light model.
Exactly. Because they aren't trying to build massive, multi-billion-dollar fabrication plants to manufacture and sell millions of transceivers themselves.
No, that would ruin the margins.
Right. They operate a dual model of material sales and IP licensing. They are essentially the ARM holdings of the photonics world.
That's a great comparison.
Thanks. They don't build the heavy fabs. They license the foundational architecture, the polymer PDK IP, to the Tier 1 transceiver and silicon photonics design houses.
If we connect this to the bigger picture, the safe, established market consensus overwhelmingly believes that silicon photonics will just incrementally scale indefinitely.
Which is naive.
Extremely. The contrarian view, the high alpha view, is that relieving the AI infrastructure bottleneck explicitly requires novel materials. EO polymers offer fundamentally lower power consumption and higher modulation speeds by leveraging organic chemistry to manipulate light.
Rather than relying purely on silicon structures.
Exactly. For Lightwave Logic, the catalyst isn't just generating revenue today, it is securing those major design wins for the upcoming 800G, 1.6T, and 3.2T transceiver generations.
Because the demand side is accelerating at an unprecedented rate. We're looking at a 10x growth in 800 gigabit deployment since 2022, and a forecasted 20x growth for 1.6 terabits since 2023.
It's massive.
The capital expenditure from hyperscalers to address AI, quantum computing, and massive datacom requirements is a tidal wave. EO polymers are positioned to be the critical enabler for those speed upgrades when legacy materials tap out.
It is the ultimate asymmetrical bet on the physics of data transmission. If legacy materials hit the wall at 1.6T, as the physics suggests they will,
the licensing value of proven EO polymers skyrockets.
Exactly, and Lightwave Logic captures the upside without the capital expenditure drag of running the fabrication plants.
The data is clear, the valuations are set, and the transition is actively happening right under the market's nose. We've torn through the physics of co-packaged optics. We've weighed the heavy manufacturing leverage and debt paydown alpha of coherent against the pure play scarcity of Lumentum.
We mapped the ecosystem choke points with Astera Labs and Marvell.
And highlighted the massive wildcard potential of electro-optic polymers.
If you remember one thing, it's this. The AI revolution lives or dies on optical interconnects. But the true winners won't just be the companies with the fastest lasers.
Right.
It will be the infrastructure players that actually master the packaging, the yield, and the system-level thermal constraints.
You cannot just bet on the computing muscle anymore. You have to bet on the physics of the connection.
And this raises an important question. If hyperscale AI clusters are shifting away from easily swappable modules toward co-packaged optics that are intimately tethered to the compute die, what happens to the massive secondary market for IT hardware? When a single, non-replaceable $100 burned-out laser effectively bricks a $40,000 GPU, the entire lifecycle economics of data center hardware breaks down.
Wow. The depreciation models on Wall Street are entirely unprepared for that reality. Keep analyzing the raw data, ignore the retail market noise, and trade smart, because the hyperscale balance sheet isn't going to fix itself.